Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So the other night, I subbed as the goalie for a hockey team I had never played with before. And it was interesting. So the team plays in a lower level league than I normally play in. Now, you might think that would be easier, and in some ways it is. The shots aren't as hard, the speed of the game is much slower. However, there's a lot more chaos because, quite frankly, a lot of the players just don't know what they're doing, especially on defense. So you're dealing with a lot of players that are out of position. They're not doing the things that you would expect an experienced defenseman to do. And it creates chaos, and it's hard to play goalie in the midst of chaos. Because despite how it might seem if you're just watching on TV, playing goalie and stopping a hockey puck isn't so much about reaction time as it is about recognition. You're recognizing patterns. You're recognizing how the puck comes off of the stick. You're recognizing how a play is developing. So you can imagine if you're playing with more inexperienced players who don't know how the puck is going to come off their sticks themselves, who are not playing positionally sound defense, it's really difficult to read those patterns. There's no pattern to recognize. And so it makes it very difficult to play in net. So during this game, I had a really hard time because they're kept developing these situations where things were out of place and it was helter-skelter and you're scrambling. And I had to really focus on staying calm and focus on my fundamentals as a goalie. You know, tracking the puck, being in the right positions, all of those things that are true of playing goalie no matter what the situation or at what level. And so I had to actually create this inner dialogue in my head. Calm down. Don't get caught up in the chaos. Don't get caught up in, the frenzies. Just stay focused and calm. And I was thinking after the game that this is a lot like the markets right now, right? There's all kinds of chaos. There's all kinds of big swings going on. Every day, it seems like there's new news that's moving the market one way or another. If you've been watching the price of gold, you've seen these big swings, $25, $50 moves within a matter of hours. When I started recording this morning, gold was down like $30, just below $3,300 an ounce. Yesterday, it was up near, $3,350. So you see these big swings, and I think that's going to be the norm for a while because, quite frankly, it's the nature of our president, right? Tariffs are on, tariffs are off. They're on some things. No, they're off some things. Tariffs might be back or not. So when you're in this environment where the headlines are changing and the news is shifting so quickly, you have to do what I did in my hockey game. You have to stay calm. Right? You have to focus on the fundamentals. You have to filter out all of the noise and try to focus in on the things that are just baseline, right? That are not going to change, that aren't going to be subject to a new tweet tomorrow. And there are those things, right? There are things that are pretty set. They're not going to change quickly. The debt bubbles aren't going anywhere until they pop. The malinvestments in the economy that were caused by years and years of easy money aren't going anywhere. The fact that the Federal Reserve is in this catch-22 where they need to lower interest rates because the economy is addicted to easy money. It needs the easy money to help keep the debt bubbles blown up. And yet, on the other hand, we still have this inflation problem. So, the Fed arguably needs to hold interest rates higher for longer. That dilemma isn't going anywhere, right? The dollar isn't going to suddenly start getting more valuable, right? They're not going to turn around and start, instead of devaluing your money, making it worth more. It's just not going to happen. And, that's a big part of the reason that gold has gone up so much. It's not so much that the gold is getting more and more expensive. It's the dollar becoming less and less valuable. Your dollars are losing value every single day. And I've said this before, even when inflation is quote unquote under control, the policy is still to inflate at least 2% per year. So every single year, they're devaluing your dollar by 2%. So that means every 5 years, your dollar is devaluing by 10%. And so it just keeps adding up and adding up and adding up. And, the value of gold is relatively stable over time. You can see that, like, if you look back in 1900, 1 ounce of gold would basically buy one nice suit. And today, an ounce of gold will basically buy one nice suit. I actually ran the numbers on this last year, and a suit is actually cheaper based on an ounce of gold than it was in 1900, which makes sense, right? Because as we become more efficient, we become more productive, then prices of things should naturally go down. But the fact of the matter is that if you look over time, that ounce of gold buys basically the same stuff that it did, 100 years ago. Analyst Jesse Colombo wrote an article about this over at moneymetals.com/news, and I'll link to that on the show notes page. Its title is "Gold Isn't Going Up, Your Money is Just Losing Value." And he wrote, quote, "I used to brush that off as a cliche or a semantics game, and honestly, it annoyed me. But eventually, I decided to dig deeper. I started analyzing the data visually, my favorite way to learn, and that's when it really clicked. They were right." And he has a bunch of charts in that article that shows how the dollar has devalued and how that has made the price of gold go up. So check that out. But, those are the things you have to keep in mind in these very uncertain, very volatile times, right? No matter what happens, you know that the federal government is going to keep devaluing your money. And so you always need to be aware of that and hedging against that as you try to plan for your financial future. So on the subject of the inflation-adjusted gold price, last week, gold quietly hit a very significant milestone without a whole lot of fanfare, really, and it took out its all-time high in real terms. And of course, we've seen records falling, it seems like almost every week. We've had this new record high in gold. And let me give you some perspective on this gold bull run obviously I do this every day, so I know how much gold has gone up. But when I saw this, it really was pretty staggering. In October of 2023, gold was at $1,830 an ounce. Today, the yellow metal is trading around $3,300 an ounce. That's a 75% gain in just 18 months. And along the way, gold set 40 new all-time highs last year alone. And that's based on the London Bullion Market Association afternoon price. I'm going to get into gold pricing here in a minute, what we mean by these different prices. But just that to say, we've seen a lot of records fall over the last 18 months. But most of those records were in nominal terms, right? When we talk about an asset's real price, we're referring to the price adjusted for price inflation as measured by the CPI. So how has gold done on a real inflation-adjusted basis? Well, on April 22nd, gold cracked $3,500 at its intraday high. And that broke the previous high of $3,493 in today's terms that was set on January 21st, 1980. And on that day, the yellow metal hit an intraday high of $850. So just think about that. $850 in January of 1980 is basically the same as $3,493 today. That's how much the government has devalued your money. Gold also touched an inflation-adjusted high last fall, and I wrote about it. But of course, price inflation has increased since then. So that's raised the value of that $850 1980s dollars even higher. So of course, as price inflation continues to increase, the value of a dollar priced in a date way back in time, that continues to go up and up and up. Now, I want to give you a little bit of perspective when we're talking about these inflation-adjusted high, because you might look at that and you might say, well, we're just now getting to the high of 1980. Gold's not a very good inflation hedge. Well, first off, it is an inflation hedge because at no time, could you have lost money on an inflation basis buying gold, at least as of that date. Now, gold has fallen off of that over the last couple of weeks. But think about this. Gold didn't stay at that 1980 record of $850 for very long. At the time, Federal Reserve Chairman Paul Volcker was aggressively raising interest rates to battle price inflation. And in February 1980, the Fed pushed interest rates to 15%. And then in March, they drove them all the way up to 20%. Okay, so that's what a real inflation fight looks like, by the way. Not what are we today? We're like at 4%, 4.5%, somewhere in that ballpark. We got to 5.5% as the big, inflation killer. Ooh. Anyway, Volcker, he did it right. He killed inflation. He crushed it. And gold quickly fell off of the January 1980 high. And by the end of the year, it was back below $600 an ounce in nominal terms. And it continued to trend downward for several years as Volcker's inflation fight bore fruit. Now, I think it's important to point out that the fact that gold traded below its 1980 real price high for decades doesn't mean that the yellow metal, quote, hasn't kept up with inflation, as some people will claim. That year was an anomaly, right? Through most periods, the price of gold has outpaced inflation as measured by the CPI, and it has served as an excellent inflation hedge. I wrote an article a while back that traced the price of gold since the turn of the century, and you can see that it has generally been an inflation hedge. In other words, if you bought gold virtually any time after 1980 and held it till today, you're well ahead of inflation. And now you're on pace with price inflation, even if you bought it at the high on that January day in 1980. Right? So for instance, if you bought an ounce of gold in 2000, you paid around $285 an ounce, well below that 1980 high in both real and nominal terms. And since then, gold is up over 847% in nominal terms, while price inflation over that same time is around 81%. So actually did much better than inflation. Now, of course, the return on any investment depends on exactly when you buy and when you sell, right? If you happen to buy gold at the peak of a bull cycle and then sell at the bottom of a bear run, you're going to lose money in both real and inflation-adjusted terms, right? If you bought at the high at $850 an ounce in January 1980, yeah, you had a hard time making up that difference. But any other time, almost around there, like I said, gold came off of that price pretty quickly. So you're actually doing better. But you can't just always pick an arbitrary date. And people like to do that. For a while, everybody was like taking 2011 when gold peaked after the monetary malfeasance of the Great Recession. And they would take that 2011 price and then, in 2018 tell me, see, gold's doing awful. Well, look at it today, not so much. So this goes back to what I was talking about with my hockey analogy. You always have to look at the longer trends, right? You have to look at the fundamentals and the basics. You can get caught up in day-to-day trading, in day-to-day numbers, in day-to-day data, and whatever headlines on X or, whatever. But you also have to always keep these long trends in place. And I've said this before, my investing strategy and my perspective is long-term. I'm looking towards, retirement. I'm looking towards down the road. I'm trying to preserve my wealth in this crazy inflationary times. And so I try not to get too wrapped up in, the big price moves on a daily basis. So while we're on the subject of pricing, I thought it would be a good idea to go over how the price of gold is calculated. Like when you see the price of gold, what does that mean? Where are they getting this number? And quite frankly, it can be a little bit confusing, right? You might go to moneymetals.com and you might look at that ticker and you might see the price of gold at, say $3,300 an ounce. And then you might go to another ticker somewhere else and it might say $3,310 an ounce. And you might go somewhere else and maybe you turn on CNBC and you hear that gold is $3,400 an ounce. Where are these prices coming from? Why are you seeing these discrepancies? Well, the first thing to understand is there's actually more than one price for gold that could be quoted at any given time. There are three main prices that you can see quoted. So I'm going to cover each of the three and kind of clarify what they mean, what those particular prices are telling you, and how you can use them as you evaluate the gold price. So let's start with the spot price of gold. If you go visit moneymetals.com and you see the price ticker on the top of the page, what you're seeing is the spot price. And this reflects the current market price for immediate delivery and basically serves as the benchmark for real-time pricing and trading activity. So if you go to any gold dealer, you're going to get the spot price is going to be the price that you're going to be talking about. Now, who sets the spot price? Well, nobody does. It's not set by an entity. It is determined by decentralized global market activity. The spot price you see quoted on various financial news platforms is a composite, and it's derived from real-time trades across multiple exchanges and trading platforms. So it's an amalgamation of data. This data is compiled using both over-the-counter markets and formal exchanges, and it includes private trades between institutions, dealers, and banks. Major dealers such as JP Morgan or HSBC or UBS, these big banks, they also influence the spot price by continuously quoting buy-sell offers. So all of these numbers are consolidated. You get all these numbers out there in the market and it gives you an average spot price. Retail investors, dealers, and traders rely on this spot price as their primary reference. So again, if you buy gold coins from Money Metals, the spot price is going to serve as the starting point for that purchase. Now, if you go on our website and you look at the price of various products, you're going to notice that nothing is for sale at spot price, right? You're generally going to pay a little more than the spot price anywhere you buy, right? If you buy let's say an American Gold Eagle 1 ounce coin, you're going to start with the spot price. So today it's like right around $3,300 an ounce. And then there's going to be a premium. It's going to cost a little more than that. It might be $40 or $50. I don't know what the premiums are, to be honest, but it's going to be higher. And different products have different premiums. So you might see, that Gold Eagle have a relatively low premium. You might go to, a specialty coin or an artistic coin, and the premium could be much higher. Specialty products are always going to have higher premiums than, your more standard products. And if you're just trying to get the best value that you can, you try to pay as little premium over spot price, you can talk to a Money Metals precious metal specialist, or you can peruse the website and you can find the products with the lowest premiums. Premiums in some sense are supply and demand, and some of them are just based on, again, if it's a specialty product. So like if you have one of these gold bars that you can break into smaller pieces, like they're almost like candy bars, and you can break them into smaller pieces that ostensibly could be used for barter. Well, that's going to be a higher premium than just a basic coin because it's a specialized product. And, I often see comments on our Facebook page with some of the specialty products. There's a silver bullet that I've seen for sale on the website, and it's quite a bit over spot price for silver. It's a bullet. It's a novelty item. It's a specialty item. Of course, the premium is going to be higher, but people are complaining, this is so much over spot price. First off, I never really understood why people go on Facebook and complain about a price. If you don't like it, don't buy it. I don't know why you have to commentate on it. But anyway, that's out there. But that's the reason, right? Specialty products are always going to have higher premiums. And if it's a specialty product that you like, you really, really want a silver bullet, and you want to give, your kid a silver bullet for some reason, well, you're going to be willing to pay that premium. And it's the old adage in economics: value is subjective. And you may look at that, I would never pay that much over spot price. Well, somebody else might, because they like that particular product, right? They might like the Irish coin with the beautiful engraving on it, and they might be willing to pay a little more for that than, say, a plain old Canadian maple leaf. So anyway, that's kind of the deal with premiums. That's how dealers, we got to pay our bills and our overhead and make a little bit of profit. That's where the premium comes in. So you're always going to play spot and then the premium over spot. So you're also going to see outlets quoting what is known as the futures price. And this is different than the spot price, and it represents the agreed upon contracted price for gold delivered at some future date. And it basically reflects markets, or the market expectation of what the gold price is going to do at the time the contract expires. So what's a futures contract? Well, it's very simply a contract or a legal agreement to buy or sell a set amount of gold at a predetermined price on a specified future date. So most standard contracts are based on 100 ounces of gold, and futures contracts primarily trade on the COMEX division of the Chicago Mercantile Exchange, CME group. So you'll hear about the COMEX. That's where futures trading is done. And the futures price is basically an indicator of the sentiment around gold, right? So you might see the spot price at, say, it's $3,300, and the futures price might be $3,400. Well, that's showing that the market is anticipating that gold is going to go up $100 an ounce within the next month or within the length of that contract. By the same token, you could have the spot price of gold at $3,300 an ounce, and the futures price might be $3,250 because they're expecting the price of gold to go down over the span of that contract. Most futures contracts are closed out before the expiration with an offsetting trade. So basically, it's just paper that goes back and forth. But some of these contracts are settled by physical delivery. So you can actually, at the end of the contract say, no, I'm not going to roll this over. I want the gold. And it really just depends on the intent of the contract holder. Again, future prices can differ significantly from the spot price due to all kinds of factors, including interest rates, storage cost, market expectations. So the futures price is primarily the domain of speculators, institutions, and hedge funds that are, looking to hedge and make money, basically gambling on the future price of gold. But it does give you a very good sense of where the market sentiment is. How do they anticipate gold moving in the future down the road? The third price that you'll often see quoted is called the London gold price, or sometimes you'll hear it referred to as the London gold fix. And this basically sets a globally recognized benchmark price that is used by financial institutions, central banks, and investors. This price is set twice daily by auctions that are held by the London Bullion Market Association, or the LBMA. And they hold those auctions at 10:30 a.m. and 3 p.m. London time. And so you've got this large group of LBMA accredited financial institutions. They're the big banks, JP Morgan, HSBC, UBS, and they go into these auctions and they submit buy and sell orders, and therefore they fix a price. So here's basically how it works. They'll open the auction with a proposed price, maybe say $3,300 an ounce. That's my number for today. And then the participants will determine the amount of gold they want to buy or sell at that price. And if the selling volumes, if they match within a pretty tight tolerance, so it's plus or minus 10,000 ounces, then that price is fixed. If there is not a match within that tolerance, then they're going to adjust the price, repeat the process until we find an equilibrium, and then that is the fixed price. The LBMA isn't the only organization that sets a benchmark price, interestingly enough, although it is the one that is typically used in global trade. But we also have a spot price or a fixed price that is set by the Shanghai Gold Exchange, which sets a regional benchmark for the Chinese and the broader Asian markets. And there are others out there as well. But these the fixed price is generally used for contracts, more formal things. It's not something that you as a retail investor are really going to worry about, but it does give you kind of this moment in time based on this auction about where the price is, and it will influence the spot price. So kind of summing up these three different prices, you've got the spot price, which is the go-to quote for buying and selling bullion at any given moment. It's what you're going to start with if you call moneymetals.com or any dealer. You have the futures price, which reflects price expectations for the future. And then you have the LBMA fixed price, which is a formal benchmark, I can't talk today, that is used for contracts and other purposes, but is not used in any kind of real-time pricing. So those are kind of the pricing benchmarks that you're going to hear out there, and each one is something different, and it's good to kind of keep up with all of them because we'll give you a overall view of what is going on in the gold market. And what is going on in the gold market and the silver markets right now we're in the midst of a bull rally. And of course, in any bull rally, you're going to see ups and downs, especially now when there's so much volatility. There's going to be a lot of ups and downs. And, as a lot of investors are fond of saying, any bull market climbs a wall of worry, right? And, price will get a certain level, they get overbought, people worry, they panic, it can't go up anymore, and then they'll sell, and you'll see the price go down. But overall, it's going up over time. So we are in the midst of a bull market, and it's important to remember that. It's important to remember the factors that are driving the bull market, and keep in mind, okay, what are these fundamentals, and are they going to change? And I'm going to link to a couple of articles on the show notes page. One of them is by our analyst, Jan Newhouse, and he talks about $16,000 gold. Is that a possibility? And another article talking about, can this bull run continue? I'll link to a few of those just to give you a sense of kind of a bigger picture and maybe kind of help you clear your mind of whatever headlines are dancing across X today. But here's the thing. You can't take advantage of any kind of bull market unless you buy, unless you get in. And I think there's still opportunities for big gains in both gold and silver, especially silver. We talked about silver last week, about how it's kind of been a laggard. But if you look at, all of the data and you put it into a historical context, silver is significantly underpriced right now, and there's every reason to believe that at some point in the future, that's going to, come back to the mean, and we're going to see the price of silver rally to catch up with the price of gold. So there's that buying opportunity there. So I highly encourage you, pick up the phone, call 800-800-1865, talk to a Money Metals, precious metals specialist today. And again, if you're worried about premiums, they can direct you to the lower premium products. If you're looking for a specialty product, they can direct you there. They can help you figure out how gold and silver can fit into your particular investment strategy. Folks are fantastic, worth talking to them. But if you don't like talking on the phone, you don't have to. You can go to moneymetals.com and you can chat with a precious metals specialist online in a chat. Or if you know what you want, or you just want to shop, and be unbothered, browse as the saying goes, then you can go to moneymetals.com and do that as well. But do it today. At some point, this bull rally will run out of steam, and you don't want to be left with nothing when that happens. So don't put it off. Take action today. So we're going to call that a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform. We're also on YouTube. And when you do, you'll also be able to tune into our Market Wrap podcast that airs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver, economics, and investing. I get to talk to Jim Grant this week, which I'm really excited about because he's one of my favorites. So tune into that. Thank you so much for listening to the show. I really appreciate it. If you like what's going on here, please do us a favor. Go to your podcasting platform, like, comment, share the episodes, help spread the news about the show. That really helps us out. I hope you have a fantastic rest of your week, and I will be back here behind this microphone once again next week.